Hello and welcome to the Mutual Fund Guide. It's all about your funds and your returns. I am Muralidhar Swaminathan. In this special edition of Mutual Fund Guide this week, we are looking at a slightly different product than what we usually look at. We usually look at investments in equity funds, balance funds and so on and so forth. But there is a different product that's come to the market from Reliance Mutual Fund. This is about investing in debt for a long term. Not just a long term, a very long term, maybe 10 years, maybe 20 years. I would let the guest from the Reliance Mutual Fund talk about the product. Let me introduce our guest. As always, we have Hemant Rustagi, who is a veteran in this field, and introducing Prashant Pimple from Reliance Mutual Fund, who's just launched and closed this special product. Gentlemen, welcome to the show. Prashant, let me come to you straight. Can you tell the viewers about this product? Why is this different from the existing products?
Thanks, Murli. This offering from Reliance Mutual Fund, which is called Nivesh Lakshya Fund, is typically for investors to plan their medium to long-term goals. Now, people have different kinds of goals, be it their retirement goals, be it child's marriage, or say child's education. Even if investors, they have to pass on, individuals, they have to pass on their wealth to the next generation. This is a product which fulfills all these requirements.
Right. So how long is the duration one is looking at? 5 years, 10 years, 15 years, 20 years?
So I call this product that this product is up to 25 years.
Right.
Typically, we advise investors to be in this product or look at this product from 10 years plus perspective. Today, if you look at in the market, yes, there are investments option available in the fixed income space, which are 10-year plus. But here, we want to give an option to investors at least up to 25 to 30 years, wherein investors, even younger investors, can plan their long-term goals in a very visible manner.
Right. So someone who is in the age group of 30 to 40 can definitely plan for retirement with this product.
Certainly.
So where will you invest this? Are you going to invest only in Government of India securities, or like any other product, invest in debentures of companies and other issues?
So this product is meant only to invest in Government of India securities, typically long-term Government of India securities. And why we are keeping it that way is whenever in India typically you talk about long-term products, security is of prima facie importance.
Right.
And that's where this product comes into focus, that Government of India bonds gives you security from a long-term perspective, liquidity from a long-term perspective.
Right. Okay. Let me come to Hemant. Hemant, you've seen many products, both on the debt and as well as equity side. On the debt, we have products which are for very, very short term, which are for 2 years, 3 years. But this is different. We are looking at 20, 25 years. But in 20, 25 years, do you think an investor would be able to get a return higher than FD, number one? Number two, will they be able to ride the market risk that is there? There is no capital risk in this. It's a Government of India bond. What about the market risk that is there?
Well, I think, Murali, there are two important aspects here. If you look at the current offering which are available for investors, especially in the mutual fund space, I think there was a gap in terms of where somebody wanted to input money for a longer term. There was no product which allowed you to do that. I mean, you have typical duration fund, for example, where the maturity would be 7-8 years. So it was more of like, riding the interest rate cycles, and investors didn't know really what to do. I think this product fills the gap as far as the long-term investment is concerned. My belief always is when investing for 20-25 years, equity is the best class. But not that every investor is investing in equity. Some part of the portfolio you always want to invest in debt. I think there was a gap there, because if you really look at what are the options available to investors there, you are typically buying tax-free bonds, you're putting money in fixed deposits, or you're buying annuity products, for example. I think this is comparable and even better than them, the way I look at it. The reason being that when you're investing in a longer term government security and you're investing today, you're locking yield at that particular level.
Right.
I think the key factor for investors is look at longer duration, not look at this as a typical debt fund and trying to see which way the interest rates are going and trying to take advantage of movement in that. This is not a product, I think, which will fit into the game plan of those investors.
Right.
Someone who is looking for 15-20 years, wants some part of the portfolio to be invested in debt.
Right.
I think this is a good product. So I thought like there was a gap in the market in terms of allowing investor to invest for that period. I think this product.
I think this product fills that gap. So therefore, let me take this question back to Prashant. If somebody wants to, let me simplify this for the purpose of our viewers. There are many people who call us and ask us, I want to invest in FD, but I want to move out and move to mutual funds. So the FD is giving you a certain amount of safety. This product is also giving you some amount of safety. Surely this has to give a return higher than the FD. That's the only reason I need to invest in this. Otherwise, I can keep renewing my FD once in 5 years or once in 3 years, or as the case may be. What kind of return or approximate value an investor can get? Somebody puts in 1 lakh today, say 25 years later, an approximate kind of accumulation that one could see.
Let me just give you slight background before answering this question. Typically how this product is going to be managed. Once investor invest money, this money goes into the long-term GSECs, typically 25-year GSEC. Any fresh money comes in, goes into the same GSEC. Any interest income which comes from the government on this investment goes into the same GSEC.
Right.
And the maturity keeps on coming down as the investment keeps on getting older in this fund.
Right.
So the volatility aspect, what we are talking, probably that is a parameter in the initial part of the investment. As the investment grows old, your volatility comes down drastically.
Right.
As far as the value of 1 lakh rupee in this product as compared to many other products, so currently where the interest rates are and where these 25 years government bonds are available, and assuming that these bonds are available in plus minus say 50 to 100 basis point from here for next say 10-15 years.
Right.
Typically your 1 lakh would grow to around 7.5 to 8 lakhs, a range of basically 7 to 8 lakhs over a period of 25 years. And what I'm doing here is nothing different but a simple compounding. Because what this product is all about is understanding how the compounding works in a disciplined manner. Though as Hemant rightly said that, or you rightly said that, no one has looked at fixed income mutual fund for more than say 3-year or 4-year kind of product. So when you look at fixed income from a 10 years, 15 years, 20 years perspective, compounding becomes the main element of returns and cushion against market volatility as we go ahead.
Right. Hemant, comparing the two, suppose you compare this with an annuity product, can I expect the same kind of return, say 7 to 8 times over a period of 25 years?
I think this product should give you better than what you get in an annuity product. I mean, there are two important things. One, you need to look at what is the underlying here. It's a long-term government security. And second thing, I think you need to also look at the tax efficiency of returns. What typically happens in annuity is it's taxable.
Right.
Here, if you invest for a longer period, because this is not a product for 3 or 5 years. This is a product where you're taking a call for 10, 15, 20 years.
Right.
And if you remain invested, what happens is it becomes a long-term capital gain and you get the benefit of indexation.
Right.
That, to me, I think makes a huge difference in terms of what you get to keep. And you can set up a systematic withdrawal plan. Right. Allow it to accumulate over a period of time.
Right.
Set up a systematic withdrawal plan.
To meet the cash flow requirements.
And that works like annuity for you. So difference is that in annuity, maybe you get guaranteed, okay, but it's taxable.
Right.
And the annuity is very low, in fact, if you really see. Here, over a period of time, even if you're looking at, let's say, 7.5%, with the tax efficiency, I think it's going to be better.
But will the timing be a problem? Let's say someone wants to start withdrawing after 10 years, to meet monthly expenses, to meet their cash flow requirements. Do you think at that point in time, the market price would erode the value? Is that risk there?
So as we are telling our investors, Hemant also covered that typically this is for investors looking at 10-year, 15-year, 20 years kind of a asset. So once you allow your investments to breathe over 5 years or 10 years period, there is enough interest income and compounded interest income which gets built up into this portfolio that the market volatility aspect really comes down over a period of time. Secondly, one of the most important feature of this product is that the maturity of your product keeps on coming down as you get older into this product.
Right.
So as the maturity comes down, the volatility also comes down. So typically when a person is retiring or he needs the capital back, that is the time even with large volatility in interest rate, your capital won't move much.
Correct.
Because your maturity is already very low.
Right. Do you think investors should go for a lump sum investment, or would you prefer SIP? How would you advise? What would you advise?
Well, it depends. Obviously, if you invest lump sum, it will make a difference to you, because then you're looking at the current rates.
Correct.
But then not everyone will have a lump sum. But I think even if you try to accumulate over a period of time, I mean, I think this product will still work for you. So it clearly depends on whether you have the lump sum or not. I mean, like I said, if you want to allocate a part of it to debt for the long term, and if you don't have a lump sum, you have no option but to go for investing systematically. Not necessarily systematic SIP. It could be like, okay, once or twice a year, whenever I have money, I'm putting it there. I think it's just a question of maintaining the discipline of investing on a regular basis.
You want to add to that?
Yeah, so here I want to add something that actually if you look at the dynamics of any compounding product or any fixed income product, when we are talking of 10, 15, 20, 25 years product, even if someone who is entering, say, at the current rate of 8 quarter, or someone who is entering at, say, 8.75 or 9%, which is good enough volatility as far as interest rates are concerned, but the end result after, say, 20, 25 years, because of this volatility or the difference of 1%, is very, very small.
Right.
So that is what the beauty of product is all about, that over a period of time, the differences which occurs at the entry point in time comes down to a very zilch level.
Right. Okay. My next question. Your portfolio. You're saying you're going to focus only on G-Secs. What is is there enough long-term securities available in the market? Generally 5-year, 10-year paper, there must be more supply. So is there enough security available for a 20-25 years?
Yeah. Of late we have seen, last couple of years, the government bond issuances in the longer end is good enough to cater to any requirements into this product. Typically, every week we have close to 2,000 to 3,000 crores of issuances coming from Government of India into this segment of maturity of Government of India securities. Secondly, we already have good amount of outstanding stock of these papers in the market, which are readily available on the RBI screen where Government of India securities are dealt, or in the secondary market, or in the primary market auctions also. So availability is certainly not an issue, and being a Government of India security, liquidity is also not a problem.
So liquidity is not a problem. Anytime you need to move in and move out, it must be easy.
Yeah, that's not difficult.
That's not a problem. Okay, very interesting product, except that, as we go along, I'm sure other funds would also follow this and they will not. But Hemant, would you look at, for a fixed income investor, this is of course long term. In the current market scenario, when yields are still going up, yields are still not stabilized, interest rates are going up, how should a fixed income investor approach? Should they invest and get in now, or exit fixed income products if they are already into it?
Well, it depends. It depends on whether you have an existing portfolio or you're trying to build a portfolio now. So let's talk about someone who's trying to build a portfolio.
Yeah.
Clearly, I think the key factor, like any other investment, will be your time horizon. Now, for example, if someone looking at 3-4 years, this product is obviously not for him.
Correct.
There, I think it's a great opportunity for investors to lock in their money in fixed maturity plans.
Right.
Because today, currently the yields are very high. You lock in money at that level, and because of tax efficiency and the fact that you can get higher return, FMPs are a good product. Hereafter, like I said, if you're investing for long term, you can look at a product like what Reliance product is. So there are different options available to you. But for the existing investor, someone who is in a duration kind of portfolio or something, I think there is a need to realign the portfolio now, and maybe look at a credit risk kind of fund, which basically works on accrual basis. So I think that will be a good option for people to look at.
Right. Before I go to break, I think one more question. The tax efficiency part. There is an indexation benefit. I think the net impact of the tax on this must be less than 7-8%?
So typically in debt mutual fund, the taxation works like this, that after 3 years of your investment, you get the benefit of indexation, and after indexation, you are charged at the rate of 20%.
Right.
So just to give you an example, say for example, the returns are in the range of say 8.5. And your inflation is say 5 to 6%. Then the differential is close to 3%. And 20% on 3% is basically 50 to 60 basis points. So effectively, if you look at the 60 basis point divided by the overall gross return, it is slightly less than 10%.
Slightly less than 10%. It's tax efficient, an interesting product that's come to the market. If you are a long-term investor I think if you look for safety, security, I think this product is something which you could look at. For details, obviously you'll have to go back to your fund advisor and figure out what your requirements and goals are. On that note, we will slip into a short break. When we come back from break, we'll take questions from viewers. Welcome back. Thanks for patiently waiting by and watching Btvi. You are watching Mutual Fund Guide, and let's take the queries straight away and not discuss any more fund options at this stage. First, let me go to Ajay Wala, who sent this mail. He is from Mumbai. He is a 19-year-old student. He wants to start an SIP for 1 year, which will give him a return of 25,000. He is looking for suitable fund names. He also wants a suggestion on what his SIP amount should be. He is looking for 25,000. But time span, I guess, must be 1 year that he is looking at.
Well, I think key factor here is time horizon. If you're looking to invest for 1 year through SIP, your average holding period is around 6 months. So I think he has to be really careful in terms of where he invests his money. So at best, he can look at maybe, ultra short-term kind of fund.
Right.
There again, the last installment which is there when he exits, there might be slight exit load in some of the funds. Right. So you need to be a little careful there. And I think in terms of return also, it'll be maybe slightly higher than what he can get in the bank. So I don't think he really has a time horizon to look at too many options from mutual fund space.
Right.
Maybe either he can look at doing recurring deposit in the bank itself,
right,
or at best he can look at ultra short-term fund.
Ultra short-term,
but that's the best kind.
That's the best kind. But I think being a student, at least he has turned his eyes to mutual fund industry,
which is great. I think the fact that he is looking beyond traditional options, which means that he is willing to kind of figure out what are the best options for him.
Absolutely. Okay. On that note, let's go to the next query. Jitendra is on the line from Bengaluru. Good afternoon, Jitendra. What's your query?
Hello?
Yeah, good afternoon, Jitendra. Please continue.
Yeah, I have a 20 lakhs rupees FD in ICICI Bank.
Continue, sir.
And I have invested in 3 mutual funds which I already listed to you, SBI, Blue Chip and ICICI and HDFC small cap, and Birla Sun Life. 30,000, some altogether 1.8 lakhs invested.
Yeah.
Now what I want is from the 20 lakhs FD from the bank, I wanted some 20,000 rupees return per month. Can I shift it to the same mutual funds or what?
Yeah. Okay. Let me toss to Hemant.
His investment is 20 lakhs. He's looking to get 20,000 per month. So if I look at annualized return post-tax in terms of income, is looking at 12%.
12%. Yes,
I mean, mutual fund will give you all the options that you need. Mutual fund can give you higher return. But I think it's very important to have your expectation very realistic.
Right.
Yes, I mean, if you invest in hybrid funds or equity-oriented fund, these funds can give you that kind of return. But as a dividend yield, it's very, very difficult to get on a consistent basis 12%. So my, advice would be to bring expectation down to, yield of around 7 to 8%. If he's willing to take some amount of risk, he can look at some hybrid funds. You have balance advantage kind of fund, or you have a balanced fund, mix of these. But let me say, because there is an equity component, there is going to be some amount of volatility. I'm assuming that he's willing to take some risk because he's moving money from bank FD. So as long as he understands what are the attendant risk of that, he can actually do that. So like 2 funds I can recommend to him is ICICI Balance Advantage and Reliance Equity and Debt Fund. He can look at a combination of these. Like I said, 7 to 8% dividend yield is something he can expect. It can vary depending on the market condition.
Right.
So plus there will be capital appreciation, which obviously will not be there in the fixed deposit. Another thing I would like to say is that if you can wait out for a period of 1 year, invest in these funds, allow it to grow for over a period of 1 year, and then set up a systematic withdrawal plan. So tax incidency, what happens there is up to 1 lakh rupees long-term capital gain is not taxable. Beyond that, you're paying only 10% tax. So if he's getting, let's say, 2.5 lakh, he would end up paying 25,000 as dividend distribution tax. Through SWP, maybe it will come down to 5 or 6,000. So I think he needs to look at these couple of factors before making a decision of investing money.
Right. On that note, let's take the next query. Anup Kumar is on the line from Kolkata. Good afternoon, Anup. What's your query?
Good afternoon. See, I want to know about the UTI next 50
Okay.
fund.
Mm-hmm.
UTI launch a new fund
Yeah.
next 50.
Yeah.
So I have deposited 20,000 for
Okay.
this fund.
Right.
I want to.
Okay. Sir,
What is the future in next 5 years?
for 5 years you want to stay invested.
Yeah.
Okay. Mr. Anup Kumar is 68. He is invested in UTI Nifty Next 50 index fund. He wants to know.
See, it's an index fund. It's a passively managed fund. Basically, what it does.